Hello, I'm Sue Saunders from Business in Control. In this video, I'm going to show you the BIC model. The platform I'm using is a Macintosh, but the principles are the same on the Windows platform. This is the user file, and in the user file you'll find a folder called the BIC Model Data. And in the BIC Model Data you have the current data file with its current version number shown here. In this folder you have an update that you download from the website when there's an update available. Normally that folder is empty when you download the program. These other folders help you with understanding the demonstration that comes with the training manual, and you can use those folders to understand in more detail how the BIC model works. Now let's open the BIC model. The program asks you to select the current file. The reason for this is that you may have changed the file or changed its name, and it doesn't really matter as long as you tell the program which file you would like to open at the time. This is important because sometimes you want to do several scenarios of your forward projections. So let's tell it which file we want and we'll open it. Now because we're doing a demonstration, or we're looking at the demonstration data, we'll type in trial and the password is demo. And it comes up with a message that says, do you want to do the demo or would you like to open a new account? In this case we want to do the demo. We don't want to open a new account because we're not starting, we're just playing with the program, and the demo is there for that purpose. So this is the home page. You can see down on the left hand side all of the different sections of the program. We'll just have a look at some of the sections and jump around the program just like you would do if you downloaded it and had a look yourself. The main thing in the program is to do forecasting. So this is a page that explains what the forecasting is about. If you go into the predictions, you can see a whole lot of numbers here. Let's go and have a look at the income. Or if you like, you can look at assets, or you can look at expenses. So these items here are the accounts, which are simplified from your accounting system. We'll go back to income and have a look at one of the line items. In the example, the company is called Gardens for High Rise, and they have quite a number of products. The indoor space saver, for instance. Let's have a look at the graph of this forecast. First of all, the black letters are actual figures and the blue letters are forecast figures. So if we click on here, you can see what's happened. That's been a little bit up and down, and then what the owners of the company are forecasting is for a steady increase. It looks like November was a bad month, but the trend line is about the same as what they're aiming for. Maybe we'll have a look at another one. This one here perhaps, indoor compost capsule. Again, it experienced low sales in November, but it's got a steady forecast. Now it's interesting that the patio compact, for instance, has a different forecast because of the knowledge that the owners have about the business and when contracts will be coming in for this product. all of this is explained in more detail in the training manual. So this is how you forecast. If you go to financial reports up the top here, you can see the financial reports for product sales. This is the operating statement. So we've got the income here and the expenditure there. This is the other income because this company does some consulting work. And here's all the expenditure. And down the bottom we see the profit that's being made. This is the past data here in black, and this is the forecast data. Now, this is for the year July 2011 to June 2012. If we click on here, we can go over to the next year and see the bottom line, if you like, out to the end of June 2013 in this example. So if we wanted to have a look at the graph here, we can choose a variation graph or a trend graph. We'll choose trend. And that shows us what our forecast profit is for right out till June 2013. Note that the actual data is from July to December. There's 6 months of actual data and 18 months of predicted data. Now, if you like, you can go and have a look at the balance sheet. And what's important in the balance sheet, you can see the assets and liabilities and the shareholder equity. What's important, of course, is your cash. So what's happening with the cash now and into the future? So we look at the trend again, and we can see that this is the forecast cash flow out to June 13. We can also have a look at the gross margin. Let's have a look at that report. Well, what the owners of the company have done is split their products into groups. So they have 3 main groups of products, and what they have done here is married up the difference between the sales and the cost of sales. So the gross margin is shown here. They have quite a high gross margin in this example. So they can keep an eye on gross margin. So now we will go back to home and have a look at the business model for this company. In this section, you can answer a questionnaire and define clearly your business model. So if we go to the questionnaire, it asks us which section we'd like to do. Now there are 6 sections. Factors relating to the offering, market factors, internal capacity factors, competitive strategy factors, economic factors, and personal investor factors. We'll just have a look at section 3. Now what you do here is answer the questions. You have a question to answer and an explanation of what the question is all about. And these are drop-down menus, so you can pick up your which is important for you, and type in your explanation. Now, in this example, the business model has been done. So if we click on business model here, we can see a completed business model. There's the 6 sections, which you can see here that we can scroll through. And it is a very good exercise to go through and answer all the questionnaire and to see if you're really clear about how your business is working in the market and what its purpose is and how you expect to make money. This is a qualitative analysis of your business, but it is done in a succinct and structured format. So it's the kind of document that you could give to your banker or your investors and they will understand what your policy is and your thinking is on how your business is being approached. If we go back to the hub, we can have a look at the business model parameters. You might wonder what that is. Well, in this program, we have 12 basic performance factors. Now, in the example, the company uses all of the 12 factors because it is a company that is a fully manufacturing, performance-oriented, ongoing concern. In some cases, if it's just purely a service business, for instance, it won't have inventory. Now, what you do is forecast your business and set future targets for the various factors. So the owners of this business think that, for instance, they'd like their cash balance to be positive at all times, between $10,000 and $30,000. For example, if it was more than $30,000, they might move money into more inventory, or they might invest the money. They expect to get $95,000 worth of sales per month. They expect a gross margin of about 45%. They have set some figures for how the level of accounts receivable they expect each month in their balance sheet. They think inventory turnover should be 40 days. That's quite a high inventory turnover. They're expecting their capital expenditure in the next 6 months to be just $10,000. They are looking for some growth in their equity from $114,000 to $120,000. So they're broad parameters of the performances they expect. Now, if you go to the financial reports, or you can actually go from here, there is a table called results. And you actually, what the program does is calculate the actual performance compared to the targets that you set in the previous screen. So here we go. We press report, refresh the report. And what we see, that message there, by the way, said that these are the results for December. There it is up there. And what you do is, if you want to see the previous 2 months, you go to past results, and that's the previous 2 months. It's the same 12 performance factors, but it gives you an analysis of your performance over 3-month period. So you can see here that we know that November was a poor month, and so the program comes up and says caution. The profit before tax is not what was expected, and they need to do something about that. The other factors seem to be okay, so they're progressing as expected. So we go back to home. Let's have a look at setup. You fill this out at the beginning when you start the program. So in this setup, we can see that our financial year is 2011-12, and the second financial year is 12-13. The forecast period is starting from January, because the data we have has been input up until December 2011. In this example, we are using MYOB as the source of our accounting data. And we're viewing the data in the first viewing quarter. With this program, you can move the quarters along every 3 months, so that the whole 18 months of actual and forecast data can be moved along as time moves along. Eventually, it is wise to update the financial years. So you just do an update and say, well, my first financial year is 2013 and my second one is 2014, and so forth. So if we go back to home again, we can see that there's a re-login button here. In this particular data file, we have entered a blank demo company. We can just have a look at that. If we go here and we type demo company and put in a password, then the program takes us over to the demo. And there's no data in this setup, so we would have to put in the year that we're interested in, and see, in this case we're going from 2013 to 2014, and start doing predictions and setting up the program. This will be the topic of another video. So let's go back to home again. If you want to update the program, you go to the update section and press the button here, and what happens is the data that you have in your current data file is brought into a clone, and then the clone becomes the new program. The original data file is not changed. We go home again. Let's have a look at setup. We have a generic chart of accounts. This is your generic chart of accounts. That's the balance sheet, which you map to your own accounting system. So let's go back to the demo and we can have a look at the mapping scheme. You see there's no mapping scheme here for this company. What you have to do is press this button here to set up your mapping scheme, and you bring your mapping scheme in from Excel. Once that's done, your program is set, and you only have to do minor adjustments to your mapping scheme as your chart of accounts in the accounting system changes. So let's go back to the home page and re-log in as our trial. Password is demo. We want to do the demo. Let's go and have a look at the mapping scheme. We're going to set up mapping scheme, and here's the mapping scheme for the Gardens for High Rise company. These are the external MYOB accounts. These are the names of the accounts, and you can see here the top one is the company's account name, and the bottom line is the generic account name. Of course, Rooftop Lightweight is not product 1.1. In the reports, Rooftop Lightweight comes up, but at least you know how it is mapped. So if we had a look at assets, for instance, the cash account here, you can see that the generic code is 6010, but there are quite a few cash accounts. In fact, there are 3. We aggregate those accounts under the one generic code. So that way, actually there's even more. There's 3 down here. I didn't even see those. So here we have 1, 2, 3, 4, 5 accounts, which are all to do with cash. But from the point of view of forecasting, we just want to know what the overall cash situation is and what our cash flow will be in the future based on the assumptions we've made in our forecast. This is a very powerful aspect of the BIC model, being able to predict your cash flow out into the future, because what's important when we go back home and have a look at the financial reports, what's important here is that we have a look at one of our accounts, is that the forecast out to the future takes into account the current data. So even if the old forecast was wrong, the new forecast always starts from the current data. You can see this more closely when we go to the predictions table. If we go to income here and we look at any one of these will do, but you can see how the forecast takes off from where we were in December and shows you what the results are out right until July 13. So the idea is that the forecast is amended every month, and if this trend here is not what you expect, well then you change it. But that one change will change the rest of your company, and so the end result is that you recalculate your cash by pressing the calculate button. I'll just show you that, and that will create a new cash forecast for you based on your change. In this case, we are running the cash just from the current data, but if I had changed the data, it would recalculate. So there we go, and it comes up and it tells you what your new cash flow is, so you can have a look at that. There we go. And your retained earnings and your current year earnings. When you set out with demonstration data, because it's actually not real data, it's fictitious data, and to get it all to balance exactly is quite difficult. It's much more fun if you're dealing with your own company and you actually are dealing with your own data. So that's the end of the video. I hope you enjoyed the very quick and rather superficial view of the business in control model. This is a financial model for your business, and remember, the accounting system tells you where you have been, but the BIC model, the business in control model, tells you where you are going, and that's what is important. Thank you for watching the video. Bye for now.